Today we have Chris Hundley joining us, talking about bootstrapping your startups. Chris Hundley started his first company in 1997 at the age of 21 while he was in college. The company was acquired in late 2002, and he knew that was just the beginning of his entrepreneurial career. After spending time as a consultant at Microsoft, Chris held executive technical roles at multiple Seattle startups and was an entrepreneur in residence at Madrona Venture Group. It's in September of 2014, he founded SiftRock, a marketing automation SaaS company, which he and his co-founder sold to Boston-based Drift, another SaaS company focused on conversational marketing. Chris now serves as Director of Engineering at Drift, and he's helping to build and manage the Seattle satellite office. Without further ado, Chris Hundley.
Thank you. Thank you, and good afternoon. Happy you're all here. It's actually a much bigger crowd than I anticipated. I didn't really know what to expect, but it's great to see everybody. So today we're going to talk about bootstrapping. This is something that I've been in the mix, sort of in the weeds on for the last 4.5 years. And so just to start it off, I want to give you the best piece of advice I can give, which is don't do it. Any questions? We're in the Q&A section now. We can go ahead and get that out of the way. But kidding aside, it's super rewarding. It's very challenging, but here's what I'd like to talk about today. We're going to go through a little bit of an introduction. I think that was covered pretty well, I think, by the introduction there, but I want to cover it in a little bit more detail. I want to talk about some of the founding principles that I have learned over the years to apply to not just startups, but most relationships, dealing with customers, dealing with partners. I want to talk about some keys to success for bootstrapping a startup. We're going to talk a little bit about the financial upside, and there we're going to get a real clear compare and contrast between bootstrapping and a venture-backed company. Talk a little bit about exit strategy and how you prepare for that and how you actually execute on that. It's a key piece of this process that most companies aren't thinking about far enough ahead of time. And I've got some stories about the highs and lows. We might not get there. It's quite a lot of content, but we'll just see where it goes. So, quick introduction. So I think that the summary given just a bit ago summarized this well. In '97, I don't know if everybody recognizes that little blob up in the upper right, but that's North Dakota. That's where I grew up. I started a company while I was in school, ended up dropping out of school, and I actually had to go to the Internet Wayback Machine to even find a logo because that company did get acquired, but about a year and a half ago it sort of disappeared from the Internet. But I had to get this crusty old logo from my first company. And I ran that company for about 5 years. It was moderately successful. Ended up selling it off just for to pay off the debt and everything. But I learned a ton. And that kind of started the adventure of what is it like to run a business. It was highly educational. I learned a ton about what does it mean to execute. I learned about accounting and business and hiring and having partners and having to deal with people and customers. And then from there, I came out to Seattle. I spent some time at Microsoft as a consultant. And then from there, I really wanted to get back in and continue that sort of startup education. What does it take to run a startup, to be a successful startup? And the approach I took was to get jobs at startups. And so from 2007 through 2013, I played roles of VP of Engineering or CTO. And I got to see a ton of just how businesses get built and all that goes into it. So from marketing to sales to positioning to how do you price your product, it's all really, really important to drive to a successful bootstrapping effort where you're really going to be by yourself or maybe with one co-founder and you're going to have to do all this on your own. In 2013, I landed at Madrona Venture, which is a VC firm here in Seattle, and then I got to see kind of the other side of it. I got to see how VCs look at founders, how they look at startups, how they decide what to invest in, what they're looking for. And that gave me a lot of insight into, as I vetted ideas for launching a new company, when would I want to bring a VC in, when would I not, when would it make sense, when would it not for them? And then in 2014, eventually landed on the idea for SiftRock and started building that out. And as mentioned in 2018 here back in August, we were acquired by Drift, which is a Boston-based company, and then we're going to build the Seattle office here. So that's my quick sort of LinkedIn done in a little bit more unique way. And it's really meant to illustrate one path I think that entrepreneurs can go through there's a lot of paths, right? You'll have entrepreneurs that they start a startup and they're at $2 billion in 3 years, and it's just this crazy growth, and you can't really explain it. So this is just one sort of example of what can happen. It took me 21 years from the day that I started the first company to actually get to that achievement that I was ultimately going for. And the meandering in the path is sort of interesting to look at. All right, so founding principles. So these are, I call it founding principles for the purpose of this presentation, but these are to me really kind of more life principles. They're things that I use in relationships. They're things that I would use for partnerships, for dealing with my co-founder, for dealing with customers. And the first one, and probably the most important, is know thyself. So some of you are too young to probably even recognize this, but this is Neo from The Matrix, and there's an important scene in this movie where he's given the guidance that the reason why he's failing is because he doesn't actually truly know who he is. And so in the context of building a company or launching a bootstrap startup, what does it mean to know yourself? Well, it really means, do you know what you're good at? Do you really know what you're good at? Do you know what you're bad at? Do you know what you love to do? Do you know what you hate to do? There's a lot of people who might come into a situation or a startup and say, you know what, I want to be the CEO. I really want to be a CEO. But they've never really given that a lot of thought. Like, what does that actually mean? What does that responsibility mean? What does that accountability mean? And so it's not enough to say, I just want to be the CEO. You really have to, in your soul, know that that's what you want to be. Also, what sort of companies and markets and things are interesting to you? Are consumer-based products interesting to you? Are B2B-based products more in your wheelhouse? Are you into social media and social networking? What is it exactly that you are interested in? And if you don't know that, you have to find that out before you go into this, because you're going to dedicate years of your life to it, and you have to love it, right? So I tried to come up with some kind of cool saying or something that would make people remember this, and this is what I came up with. If you can find something that you love to do in a market that you understand, that you're capable of building with a buyer that you know well, and you had a little bit of luck, you might actually have a successful bootstrap startup. Number 2. I don't know why that thing stops playing. It's just supposed to keep looping. But anyway, getting what you want is more important than being right. I think this applies most closely to your interpersonal relationships. If you've got a spouse or a significant other, you know that when you're having a bad argument with them, both of you generally are going to think that you're right. You're both on the right side of the argument. And that causes a never-ending cascade of problems if nobody's willing to relent and actually take a step back and try to figure out, what is it I actually want to get out of this discussion or this conversation or this relationship? And so this comes into play a lot when you're dealing with customers, for example, when you're dealing with negotiating a price, where ultimately what you are trying to do is close that deal to get that logo, to get that customer. And ultimately, it might be that your product is worth $1,000 or $10,000, but they're only willing to pay you $500. And what you really want is you want that deal. And so you might be right, your product is worth this much and they're only willing to pay this much, but what are you really trying to get out of it? That's important to focus in on. And perception is reality. So this comes all out into play when you're talking about brand and you're talking about market. So when you think of big brands like Pepsi and Coke and Toyota and all these big brands, they're creating a perception to create a brand loyalty. And a lot of it is smoke and mirrors. A lot of it is nonsense. These commercials, these old beer commercials where everybody's on the beach and they're playing volleyball and everybody's having such a great time. It's not a real accurate picture of what really happens, but it's creating a brand perception. And in these pictures, what I've illustrated here is in nature what's called diametic behavior. And diametic behavior is making yourself look bigger or more impressive or stronger than you actually are. And in nature, it's more of a defense mechanism. But in startups and in running a bootstrap company, it's more of an offensive mechanism. You're going to be dealing with large organizations who are used to dealing with vendors who are larger, that aren't just a single person or a two-person startup. And you've got to somehow, without selling your soul, make yourself look bigger and puff yourself out a little bit more than you actually are. So I'll give you one example. A customer calls up and says, hey, we were trying to do this thing and we clicked this button and this error message popped up on the screen and we're not sure what to do. My response to that would be something along these lines. Hey, great, thanks for pointing that out. What we're going to do is we're going to file a ticket. I'm going to get with the team. We're going to figure out what's wrong and we're going to deploy a fix by the end of the day today. Just that phrasing makes them see or believe, at least the hope is that the perception is I've got this team behind me that's going to now go troubleshoot this, even though I'm going to hang up the phone, I'm going to run to my laptop and I'm going to fix that bug, and then I'm going to push it out there and then let them know that it's fixed, right? All right, so keys to success. These are, the reason I say some keys to success is depending on the person, depending on the company, depending on what you're doing, everybody's going to have a different path and a different way of succeeding. These are some from my experience that have been the most important learnings in terms of the keys to success, but they're just some of them. There's a lot more we could get into. We could spend days talking about what actually made this company successful, but these are just some of the most important ones. So personal capital. I can't emphasize this one enough. Bootstrapping does not mean everything's free and you don't have to spend any money. Bootstrapping simply means you're not going to take any institutional financing. You're not going to take money from an angel investor. You're not going to take money from a VC. You're actually going to fund it yourself. And so that can happen in one of two ways. One way is you start it as a side hustle. You keep your job that you're working and you work evenings and weekends and you try to make things happen organically over time. It's going to take a lot longer, but it's something that you can do if you're in a situation where you don't have the capital to invest in what you're doing right now. The other way is to go all in. And to go all in means you're quitting your job and you're going to put in 60, 70, 80-hour weeks for the next X number of years to make this thing happen. And it takes a lot to do that. It takes a strong belief that what you're doing is right. It takes a strong belief that what you're doing is going to be successful, or at least has a really strong chance of being successful. And it takes a lot of capital, personal capital, or family money, or wherever you can scrape it together. As long as you're not going out and giving up equity in your company to do it, you are going to be bootstrapping. So for SiftRock and ideas in the B2B SaaS space, my personal preference was the all-in plan. And so for that history that you saw of my work and the companies that I worked at and the things that I did, that was all about saving money for the eventual thing that I wanted to do, which I didn't know what it was yet, right? I didn't have the idea for the company or the idea for the product yet. I just knew that someday, somewhere way out there, it could be 10 years from now, it could be 20 years from now, I would love to launch a company and run a startup. And so that money just started being socked away long ahead of time. And so count on not having a paycheck for 18 to 24 months. The reason you're not going to have a paycheck is because even if you have some early success, it's going to be what we call lumpy. In other words, you're going to close some business, and then it's going to be a 3-month gap before you close another deal. And in that 3-month gap, there's no money coming in. So there's no way to consistently pay yourself. So what I would do, and what I did here, is saved up enough money that I could go for 2 full years, pay for my mortgage, pay for my rent, pay for car payments, whatever debt I had, whatever cost of living I had, paying for food, ensure that I didn't run out of money. And then I ran out of money. 18 to 24 months still might be a little conservative, but I had a fallback plan. I had an investor living under the same roof as me, and she decided to become one of the investors in the company. But it was still in the family, and it was still bootstrapped. We didn't give up any equity for that. And then the last thing I'll say about personal capital is you've got to avoid capital-intensive ideas. And so part of this process, this comes back to know thyself, right? So if you are vetting ideas and you're thinking about what you want to do and what you want to work on, capital-intensive ideas might be the most amazing idea you've had. It might be the thing that you want to go do. So for example, before SiftRock, I had a lot of ideas in wearables and Internet of Things and low-energy Bluetooth and sort of device space. And I thought these were actually great ideas and something I could run forward with. But then when I started digging in and doing the research, it was clear that the amount of capital I would need up front was so massive that I would have to go the VC route. You know, I needed to get a factory in China to send me 10,000 units of something, and then I needed a place to store them, and then I needed a lab to go and work on things and build things, and I need 3D printers to make wristbands and all sorts of crazy stuff. And when you added all that up, it's like, well, this is north of 7 figures, and I don't have 7 figures, so I'm going to throw this out because I am not right now willing to go down that VC path yet. I'm waiting for that idea that I can go and run on my own. All right, so clear and simple value. Bootstrapping, as I always say, is an exercise in cutting corners. Every single day you will find things that you need to cut, things you really want to do but you can't, features you really want to build but you can't, marketing ideas and things you want to spend money on that you just simply can't. So you can't go out and do things like creating a whole new category, a whole new product market that doesn't exist right now. You can't, you're not going to be able to revolutionize some industry by going out by yourself and making something happen. At least that's extremely rare. There's a few examples through history of people that have actually done that, but it's one of those unicorn things that I wouldn't count on. You want to drive for the optimal chance at success here. So carve out a niche in an existing space. Find a gap, a small hole in an existing space that you feel like has a lot of value, something that somebody's willing to buy. And that's exactly what SiftRock was. It was this niche product that plugged into an existing giant $100 billion market as a small piece that could be added on. And that's why it was successful, because we didn't have to go invent a whole new thing. The easier something is to understand, obviously the easier it is for somebody to buy. If they in 10 seconds or 20 seconds really get what it is that your product does and what value it brings, it's going to be a heck of a lot easier to get them to buy, and it's going to be a heck of a lot easier to sell. Simplifying software implementation, so you don't want something overly complex. You don't want something that has a ton of setup or a ton of requirements or a ton of integrations or all sorts of other bells and whistles that goes along with it. You want something that somebody can come into, sign up for, log in, see the value, and then move on with their day. This is critical because you don't have a support team, you don't have a success team, you don't have a big sales team, you don't have a big marketing team. You're doing it all on your own, and the more you have to add on to your day, the less you're going to be doing on the product, on selling more deals, on all the other things that are more important to actually creating a successful startup. And the hardest decisions you're going to make are going to be things that you have to say no to. So somebody's going to ask you for a feature, you're going to have to say no. Somebody's going to want something else from you, you're going to have to say no. You're going to have friends that call you up and go, hey, I'm thinking about starting a startup, can you come and look at my business plan with me? No, I can't. I'm way too busy building my company to come and look at your business plan with you. Like, come back to me when you've got a 5-minute pitch, and then I might be able to have time to listen, right? Domain knowledge. So this kind of comes back to know thyself and knowing what you're interested in, what you're into. If you grew up reading comic books and you know Marvel and you know DC and you know all the characters and everything about comic books is what you've lived, then you came to me with an idea about comic books, I'd say, hey, you're the right person to go do this. You understand this market, you understand these buyers, you understand what's going on in this industry. This is a great idea for you to go pursue. If your idea is outside of your domain knowledge, not only are you going to have the challenge of building a company, which is already extraordinarily complex, you're also going to need an education on how in the heck you actually sell this thing. You're not going to understand the buyer necessarily. You're not going to understand the market enough to go have success here. So if you start with something you already know, you're going to have a huge advantage, especially over companies that try to start and compete with you who don't have the domain knowledge. And we had this experience with one of our competitors who started up a little bit after SiftRock, and they had a valiant effort towards trying to create what we had created, but they really didn't understand the buyer or the market, and you could tell by their materials and their website and everything that they were really struggling to understand how to even talk about their product to the market. And so we had a huge advantage over them because we really already understood the buyer before we even got into the business. So if you need to learn a new domain, if you have a great idea in the wearables space and you want to go explore that, that's the kind of thing that I definitely would do as more of a moonlighting side hustle type effort, because you want to get educated and you should have the time to do that. It might take years for you to really get in and learn it. And then you're going to go all in after you really know what you're getting yourself into. Your support system. This is also really critical. If you're married or have a significant other, make sure that the person you're with really truly understands the road you're about to go down, understands the risks, understands the rewards. Their support is crucial. So my wife's here. She's right there. She's been here from the beginning. Raise your hand. Come on. There she is. Yeah, she deserves a huge round of applause. Go ahead and give her some. Give her some. I'll just give you one small anecdote. When I was sort of at one of my lowest points during this process, about a year and a half in, things were sort of working, but not quite. Things were looking okay, but not great. And I was getting to the point where I was running out of money, my own personal money. And I sat down with her. I gave her the report. I showed her what was going on with the business. I showed her the deals in the pipeline, the customers I was talking to. I gave her all the financial information. And later that day, she wrote me a check and just handed it over and said, keep going, this is going to work. So that kind of support, that kind of level of interest in what you're doing is really, really important. Advisors, other founders, entrepreneurs, investors, people that can give you help. I brought an advisor in who ended up becoming my co-founder, and he provided just an incredible amount of insight into pricing and packaging, positioning, how to talk to the market, how to build the right content and media for acquiring more customers and generating demand for the product. Your professional network. So if you're going to be in the software space, especially in the B2B space, who you've worked with throughout your career, who you've interacted with, can be critical in your success. So my first, I think, 4 or 5 deals that closed all came from people that I had either worked with or got introductions from people that I worked with. They had gone on to work at company A, B, or C. I called them up and said, hey, I have this product. I'd love to show your team. And they said, come on in. and then eventually that became a deal. Without that, I don't know how I would have gotten in the door, because that's the toughest challenge in generating demand and getting customers, is just getting somebody to listen to you. And then other family and friends, shoulders to cry on, celebrating success. When you have a big success, being able to toast with somebody, you'll find that you have fans everywhere. People are just really rooting for you when you're doing this. They really feel like they're doing it with you. So have that available, because it really gets you over some tough spots. Product quality and operational excellence. The reason I put this up here is because I'm very passionate about this, regardless of what kind of software I'm working on, but in the bootstrapping case, it's particularly important. The irony is, you need to have a better and more stable product than you would if you had a large backing from a venture capital firm. And the reason for that is because when you've got a lot of money and you've hired a lot of people, if there's a problem in production, if there's a bug, if there's something that needs to be fixed, you got a team of people who you can point at and say, hey, we need to have this fixed by end of day, go do that. Now I'm going to go try to close this other deal over here. If you're by yourself, every minute you spend away from trying to get more customers, trying to drive more demand, trying to build your business and build your company is a huge time waster. And so the product's got to be stable and solid and not break and not go down and not have a lot of bugs. This is really, really important. The quality of the product also, so this first-time user experience, the onboarding, the ability for somebody to just sign up, use it, and go on is also critical. And we kind of touched on that a little bit before. Co-founder. So this is one that actually I had a big mindset shift on halfway through. I was kind of an introverted loner. I like to do things on my own. I like to control everything. I'm a control freak. I like to own every aspect of the business. And actually pretty proud of the solo achievements through the first 2 years of running this company. But Adam, who came in as an advisor about a year before he joined, he's I sort of built this Venn diagram that's kind of close to our skill set, but not quite exact, but just gives you an idea of when you're looking for a co-founder and somebody to share this experience with you, find somebody that completely complements your skill set. Take all the things that you're not good at or that you don't like to do and find somebody who just lives for those things. And that's, fortunately for us, what we found. Every little thing that I was really struggling with, man, I hate writing blog posts. I hate having to talk about the product in a way that makes me feel a little weird, and I'm not really a great writer, and I'm not a great product positioning person. Adam came in and just blew the doors off on demand and on building the right messaging for the audience. And so once he joined, we experienced 10x growth in customers and revenue in 18 months. So in 2 years, I was by myself, and then in 18 months, we had 10 times what I had built in the 2 years. And so these two pictures are two of my favorite. The one in the foreground here is the moment that we signed the final piece of paper to sell the company to Drift. So that's literally capturing him clicking the button on the e-doc for handing off the keys to the company. And then the one above is a couple weeks later, Drift has this annual conference called Hypergrowth, and we were out in Boston for Hypergrowth, and it was announced on stage that we were acquired, and that's us the next night just kind of going out to dinner and celebrating. So these are just part of the end game for you guys. Okay, so now that we're through some of the keys, and again, those weren't complete. There's a lot more we could add on to that. Let's talk about financial upside. This is one of those ones that's fun to talk about. It's also an interesting one because a lot of people are like, oh, you're just in this for the money, or yeah, is it all about the money? It's it's not all about the money. It's about having fun. It's about building a great product. It's about building great value and having great customers, building relationships. But at the end of all this, why do we take this risk? Why do we take 15 years worth of savings and dump it all on this company that we believe so much in? Why do we give up 4 or 5 years of income from other jobs? We're talking about $500,000 or more in actual income plus savings that is spent on this effort. Well, one of the big reasons is because there can be a big financial upside to this, right? We want to have that outcome. We want to be good capitalists and go out there and generate jobs and then eventually get rewarded for all of that hard work. And so I think it's important in terms of bootstrapping versus venture capital to understand why bootstrapping can be a good option. And it's not that it's a better option. It depends on what kind of company you want to create. It depends on what kind of runway you have, what kind of road you want to go down, right? So we're going to compare and contrast using some simple models. So for the sake of argument, let's just say we have 2 founders. They've started the company together, and this is hypothetical. This is not mine and Adam's case. This is just one example. And as an oversimplified example, let's just say that we've sat down in a chair and we've decided, you know what, at our age and with what we're putting into this company, we really need to get $5 million out of this. That's our goal. We want to sell this company, and when we sell it, our financial upside needs to be $5 million. So let's look at an example VC model. Since you guys are in this club and in this room, I'm sure you've seen these 100 times. This is a very generic vanilla example that's missing a whole bunch of detail, but it's just a generalized model of what a venture capital backed company might look like after multiple rounds of funding. So at the very beginning, we've got two founders who split the equity equally, and they leave a little bit aside for employees. And then they make it to Techstars, they become a finalist, and Techstars decides to fund them and takes about a 10% equity stake in the company. So that dilutes the founders a little bit. And then there's some success, and a Series A investor comes in and says, hey, we want to put $3 million into this thing, and we're going to take a 40% cut of the company. And also, something that's really common, especially with Series A investors, is they want you to increase the size of your employee stock option pool, because they know to be successful, you're going to have to go get a VP of sales and a VP of marketing and all these big roles that are going to come in and help you. And the only way you're going to attract those kinds of people is to be able to give them some piece of this company so that they can appreciate some of the eventual outcome. So we've increased the pool size for employees. And then we've had some more success, but we're kind of running out of money. We're getting to that stage of like needing to raise more capital. So we go out and raise more capital. We raise a Series B, $8 million, and we take a 50% dilution on that. Again, these are just completely made up numbers. I've seen less dilution. I've seen a heck of a lot more dilution. One startup I was at in a Series C, because we were in a down round, the company was in distress. We actually took a 95% dilution from an investor, which meant that with 130 employees, there was 5% of the equity in the company was spread among the 130 employees of the company, including the founders. So 50% isn't a crazy number if that's something you looked at and thought, whoa, 50%, that's a lot. So I've seen worse. All right, so given that, we need a couple more variables to work the model out for the outcome. So assume for a moment that we've got a cash exit with about a 7.5 multiple on revenue. It's just one calculation that's often used to decide the value of a company. A lot more goes into it generally, but we'll just say 7.5. Sometimes it's 4 or 5, sometimes it's 10 or 12, depends on the company and the market that they're in. And then we're going to say that we have an average sales price of about $800 a month for our little SaaS B2B product, which means an annual value of $9,600 per customer. So in these two models, first we're going to look at the bootstrapped exit. Remember our goal, $5 million, right? We want $5 million out of this. So in the bootstrapped exit, we've got 47.5% equity because we never gave up any equity. We never took any institutional money. We still have the original equity that we started with. We would need a $10.5 million exit in order for us to achieve our $5 million a piece. This would mean we need about 1.4 million in revenue, and we need about 150 paying customers, and our company size is probably around 5 to 7 at this point. So that's approximately what you would be looking at, and this is really common. These exits happen all the time. You never read about them because they're not billion-dollar exits, but these kinds of exits are happening 500 or 600 times a year if you look at the numbers. Now let's look at that VC model and the outcome of taking all that institutional money. So by the end, founders have about 11% equity in the company, and what this means is that we need to exit for about $56.5 million in order to hit our $5 million each for those two founders. We need about 7.5 million in revenue, and we need almost 800 paying customers. And we probably have about 32 to 40 employees at this point. So if you think about that scale difference and all that goes into that, 800 paying customers, if these are in the same market, imagine if there's only 2,000 customers total in this market. It's a heck of a lot easier to go get 150 of those 2,000 than it is to go get 800 of those 2,000, right? You're going to need a lot more money for marketing, and that's where all that VC capital comes in. And then 32 to 40 employees, if we look at a summary of sort of the impact of this now, from a personal financial perspective, both outcomes are exactly the same. We got the same thing financially out of it. But in the VC model, there's going to be a lot more investment in time, which is critical, right? So it might take us 3 or 4 years to hit 150 customers in our bootstrap model. It could take 10 years to hit 800 customers in the VC model. So let's just say 8 years and 4 years, just to make it simple. We made $5 million in 4 years versus $5 million in 8 years, right? So now even if you look at the cash per year average, or our, if you want to call it a salary, that bootstrap model actually ends up being a little bit better because we can get out and do the next one, right? So the investment in time is going to be a lot more. The investment in people, you need a bigger team. Recruiting, hiring, benefits, cost, right? That's where that VC money comes in handy. Growth, you need marketing, sales, product development. You're going to really have to build a big machine in order to hit that 7.5 million in revenue. And these things all add risk. So TAM needs to be bigger, right? You're generally, your total addressable market, if you're going to drive to that kind of revenue, has to be a lot bigger. You can do a bootstrap startup if your TAM is low, because you're not trying to be a billion-dollar enterprise. You're not trying to become a unicorn. You're trying to get to 10 million in value. You're trying to get to 1.4 million in revenue. You can do that without a gigantic total addressable market. Economic wins, right? This is something that we always talk about, is where are we at and what could happen, right? What happens in the next presidential election can affect the economy. What happens if a housing crisis happens? The risk goes up. The more money in and the more people you have and the more things that are going on in the world can add risk to it. In that bootstrap case, if you look at that and do the math, 5 to 7 employees at 1.4 million in revenue, that's a profitable company. That company's not losing money. That company's making money. And so that's another one of the key aspects of this, is if you're in that world of actually having a net profit at the end of every month or at the end of every quarter, those economic downturns don't really impact you quite as much, not unless you really start dropping off customers. Also, the additional impact of investors is going to be, on the positive side, you're going to get more introductions. They're going to kick down more doors for you. They're going to give you guidance and resources. They're going to be able to tell you what's going on with this company and that company and who's competing over here. VCs add a ton of value there. There's no doubt, and there's a real reason why people go raise money from venture capital firms. On the not so positive side, you're going to give up some board seats. You're going to have a few new overlords who are going to come in and they're going to want a say in things. They're going to want a say in your product and who you're hiring and what market you're in and how you're spending your money. And that reporting up can cause less focus on what you're actually trying to do, which is build your business. So I have an extreme example of this. A startup that I was at, I was the CTO. There were 5 executives, and we had a board meeting every 6 weeks. To prepare for that board meeting, which had about an 80-slide PowerPoint deck, we would spend 3 days, all 5 of us, building that deck every 6 weeks. So you're taking the 5 most senior, potentially most valuable assets of the company who should be out building the business, and you're sitting in a room for 3 days preparing for a board meeting every 6 weeks. I never understood that, and we always would talk about it, but we never did anything about it. It was like, well, let's get ready for this board meeting. And then at the very end, nearly 75% of all the value created through your hard work, your blood, sweat, and tears goes back to the investors. And this is the way the world works, right? The bankers have the money. If they loan it to you, they're going to have all the upside. Same happens with the VCs. So let's talk about exit strategy a little bit, because this is, again, one of those things that I think doesn't get thought about by most bootstrap startups, and I certainly had no idea how this was going to work, and this was another place where Adam came in and just really opened my eyes to how this could actually happen. In my mind, when I was solo, I said, you know what, if I build a great product and it drives a ton of revenue, and I build a great business and I have a big pool of customers, they're going to be pounding down my door. These big companies out there, they're going to see me and they're going to see what I'm doing and they're going to say, that guy's awesome, that company's awesome, let's buy them and let's go. That's just simply not how it works. So it's probably not going to go the way that you imagine. And Adam and I, at least once per quarter, we had a State of the Union offsite. We would go offsite for a day and we would talk about strategy, we would talk about our roadmap, we would talk about what was going well, who we wanted to hire, how we wanted to spend our money, and we would ask these important questions. Do you love what you do? Are you loving it every day? If you're not, what can we do to fix that? How do we keep this fun? What is our biggest risks and concerns? Hey, did we hear that a competitor over here got funding? That's a big risk, right? They got a lot of money. They're going to be accelerating faster. Maybe one of our partners decided to build the product that we built as part of their platform. Now we're in real trouble because they're just going to be handing it to their customers versus having them buy it from us. And really, who's likely to buy us? If we really wanted to sell the company, who would be the likely buyer? And we would go through all the companies in our space and think like, well, how much money do these guys have? What are these guys doing? What do these guys' roadmap look like? What are they saying in their marketing messaging? And we'd also talk about what is our number. So we'd take out a sticky note and we'd each write down, today, if somebody walked up to us with a blank check and was going to write a number on it, what would that number have to be for you to sell the company right now today? And that was just an alignment thing. We wanted to figure out, were we on the same page with what we thought the company was worth today? And were we on the same page with, like, it was kind of a factor of like, if we're having so much fun building this bootstrap company that's actually profitable, why would we sell? Well, we would sell if the upside was enough, and that was the number we wanted to write on a piece of paper, is what does that upside need to be for us to give up this great thing that we have and go sell the company? And Adam would always say deals are rare. And we would talk about these variables. They're so numerous, you can never predict who and how it's going to happen. It has to happen organically, and it has to happen with work. And this next slide I'm going to show you is some real insider information. I had to beg Adam to give this up to me. These are conversations that Adam started, and if you can't see that, way up here, 8/24/2017. That is almost a year to the day of when we got acquired by Drift. And this is Adam starting conversations with David Cancel, the CEO of Drift. And it's just through LinkedIn, and it's effectively, hey, we love what you guys are doing at Drift. We see what's going on there. We're fans of yours. We were actually customers. We had bought Drift and we were using it. And so we loved the product and we loved the company. We loved what they were doing. We loved their messaging. And their market messaging was starting to look a lot like ours, or at least ours was maybe looking like theirs. It's hard to say which came first. But we started talking about this concept of conversational marketing. And we were doing it with email, they were doing it with chat. It seemed like there was a real synergy that was starting to happen between the two companies. A lot of our customers were asking about Drift. They were buying SiftRock and they were saying, hey, have you guys heard about Drift? Do you guys use those guys? And we would give them, we would actually hand over business to Drift. And so lo and behold, through the course of a year, Adam keeps working on it. He's talking about the conference and how he's going to come and he wants to meet David. And then eventually Drift raises another $60 million. They had just raised 30 like 8 months before, and then they raised another 60. And that's another big indicator. If you're looking to get bought, look at who's raising money, because Drift can't possibly spend that kind of money very quickly on people or on process. It's actually hard to spend that. So normally when somebody raises a round like that, they're actually starting to think about M&A a little bit. They're starting to think about what's out there, what little companies can we scoop up to help us accelerate ourselves faster. So of course Adam reaches out, talks about the raise, and then eventually here we are in May of 2018, another conversation, another example of one of our customers asking about Drift, and David saying, hey, can't wait to catch up. That's 2 months before we flew to Boston and started working on our M&A deal, that last conversation there. So what you see here, and there's a lot more obviously that they talked about, but these were just the examples that Adam wanted to share with me of how to actually make a deal happen. It's not that they're going to come knock on your door and say, hey, we love you guys, we want to buy you. It's you basically going to them and saying, you guys are doing amazing things. Have you seen what we're doing? Hey, you guys are awesome. Have you seen what we're doing? Like that's the pattern that you have to get into if you want to get acquired. How am I doing on time? Good? Okay. So I have a couple of anecdotes. These are the things that people tend to want to write about when they write a book about their startup. There's some highs and some lows. Actually, I think I'm going to skip the low because it's kind of a longer story and I don't want to bring it down at the end here, but there are some really low points. If anybody wants to ever grab a coffee or grab a beer, I will definitely walk you through that story. I want to leave some time for Q&A though, so I'll skip that one. On the highs though, so I can always pinpoint the high point of this journey that I had. And it's a simple one. It might surprise you. But I'm going to put up this little guy here. So this is the beginning of SiftRock in a nutshell. This is like when I think back to how did the company form and how did it start. In September of 2014, I had lunch with a friend, and he was a VP of marketing at a local Seattle startup, actually working for Adam. And he said, hey, I have this problem. And he described this problem to me. And I said, that's amazing, actually. That's a problem that's solvable by software. And I said, is there not a product that does that? And he said, no, I've never seen a product that does that. And he said he's been looking for a year and he hasn't found one. And I said, well, I'm going to go do some research because that idea is so good. And remember, this was me at the end of about 6 months of vetting different ideas, trying to figure out what company I wanted to launch. And I went home that night, and it's funny, my brother was visiting from out of town, and he had come with me for that discussion, and we were driving across the 520. And I was so excited, and he said, why are you so excited? And I said, because if this idea hasn't been done, this is what I'm going to spend my life on for the next couple of years. Because this idea is so good, I have to go do it right now. And I went and did the research. Nobody was doing it. There was nobody who'd even been thinking about it. There were a lot of people who were asking about it. That was the cool part. I went to a few different vendor forums like Marketo and HubSpot, and people were saying, hey, does anybody know of a product that does this? And everybody would be like, no, I've never heard of one. And I just kept reading this and got more and more excited. So quickly went to work building an actual prototype alpha product so that I could show it to people. And back to those connections and how important that network is. I was able to go and show this thing to 4 or 5 different directors of demand gen or VPs of marketing at local Seattle startups because of my Madrona connection. They knew everybody. They had a big portfolio of companies. And they said, yeah, we'll get you hooked up with these guys. So I was able to show it. And across the board, every single person I showed this thing to said, if you build that for real, we will definitely want to be a buyer. And so getting good signals. In November, got an alpha customer working on using the product, helping me figure out what was missing, what features needed to be there, how was this going to work. Brought in an alpha customer in December, so now I had 2 customers using it. And then once we got through December, it was pretty clear there was a list of things that had to be done before they were going to buy, a list of features that had to be built. And built those features January, February, and in March, I remember this very clearly. I was in Seattle. I was at the Westlake Tower, which ironically is where Drift Seattle is now located, at the WeWork in the Westlake Tower. I was there for another meeting with another potential customer, and I was sitting at my laptop in the little lobby there, and I got an email from that first alpha customer saying, I just got approval for the budget. They're cutting the check and sending it to you today. And I was beside myself. I was speechless. I had tears in my eyes. I stood up and I walked around. I couldn't sit still. I was like, somebody's buying something that I made from nothing, right? So that moment, and there it is, that moment was everything to me. So a check made out to SiftRock, sent to my home address, by the way, because didn't have an office. And that was it. That was like the moment where I understood, where it really came into focus, that 20 years of pushing and grinding. Where it all came together was I built something, it was a blank text editor, and it conjured into this actual business. And then we get to 4 years later, and that's the same customer. That's one customer going, doubling in price every year, and they're about to close for their 5th year. And I brought this just as a visual aid. This is 4 years later of checks, and a lot of customers paid digitally, so this is just some of it, but there it is. My history, my last 4 years, and the acquisition by Drift. That's it.
If you have any questions, let me know, and I will come to you with a microphone.
Hi, thank you. My name's Dean. You've done a great job, I think, of outlining kind of the extremes of doing it on your own versus VC. Have you seen examples of companies that succeeded, say, going to a fairly hefty seed round from self-start, but never actually going beyond that to Series A, B, C?
Yeah, I would say there's a lot of examples of that. Let me try to think of one. Maybe Zapier is a good example. So Zapier went and they won, they were in YC. So there was a couple of guys, I know those guys actually because I worked with them on another project, but they were in the Midwest somewhere, like in Michigan, and they had this idea and they started building it. They flew out to California, they got to be in Y Combinator, they got to be a finalist, and from there they grew a massive business. Now they have taken more funding since, but it was more of a equity based, like, hey, we want to cash some of our equity out, so we're willing to take some money. But I think they got their YC money, and then they grew it to like a 4 or 5 million revenue business without taking any other money.
Thank you, Chris. That was really interesting. So for a lot of entrepreneurs, there's always this good argument or conversation, let's say, about if you have money, if someone's willing to give you money, is it always a good idea to take it or not? And I've heard a lot of emotional responses to that, about how people really believe there's one way to do it or not. How about your feedback?
It's a great question. So that quarterly offsite, that meeting that Adam and I would have every quarter, I had a couple of angels who I had met with during the initial rounds of SiftRock, because I didn't know it was going to be bootstrapped. I actually went and talked to angels and was trying to figure out if I could raise a little bit of money. And I had 2 or 3 people lined up to actually give money, and Adam had 4 or 5 people and had a family and had some backing that he could get money from. So one of the conversations we'd always have is, if we went and raised 500 grand right now from angels and gave up, let's say, 15%, 20% of the company, what would we do with that money and how would we spend it? And I think it's that know thyself thing, right? It's if you could find a way to spend that money and accelerate yourself into a bigger upside or bigger success. Like, let's say we really wanted to hire 2 more sales reps, but we knew we couldn't do it. We just knew that financially it wasn't going to happen unless we had some money in the bank. But we knew that if we could hire those sales reps, that we're going to accelerate this much faster. We would have gone and taken money for sure. We would have done it. So I think it's something that should be evaluated periodically, and it shouldn't just be a black and white, like, no, we decided to be bootstrapped, so we're going to be bootstrapped. This is the outcome of one bootstrapping example, but we very easily could have taken 200 grand at some point and just said, hey, we need a little money in the bank. We got to pay ourselves a little bit. Like, this is getting a little tough to come to work every day and work for nothing, right? So could have done that, but in this case, it just worked out that we didn't have to.
Hi, I've got a question regarding how attractive startups are to potential investors, let's say at a later stage. I guess I've heard a couple things. One is if you're accepting money, as this gentleman had said, on an ongoing basis, you've got a lot of people with their fingers in the pie, and that larger, maybe strategic investors aren't real interested in having a lot of people with their fingers in the pie. They want to be, they want to be the investor.
Yeah.
What is your sense from having been on both sides of the situation?
Yeah, it's funny, when my time at Madrona, I actually saw a couple of deals where the investors on the Madrona side, the VCs, actually wanted to invest, but there was another investor involved. They were like, we've dealt with them before, they're a little heavy-handed or whatever, and I'd rather if we could lead the round, then maybe we'd come in. But they're asking us to be a secondary investor in the round, so we're not going to do it. Does that kind of answer that to some extent?
Yeah, just the number of investors that have, if you're getting a bunch of rounds, you're getting a bunch of people putting in, your shareholder sheet looks polluted, right?
Yeah.
Who are these people and why are they investing?
Yeah, for sure. So he's asking, I'll repeat that, he's asking about the cap table. When the cap table starts growing and you just see all these people on it, that's very true. And it actually, part of this M&A discussion with Drift, a lot of the back and forth was, we had a few folks who, like our attorneys, for example. I hired an attorney who deferred fees so that we could give them a little equity in the company, so that I could not have to spend tens of thousands of dollars on attorney fees being a bootstrapper. And does Drift want those attorneys that are in Seattle who are not Drift's attorneys to be on the cap table? They don't. They want it to be as clean as possible, right? And so a lot of times the negotiating back and forth involves removing investors by paying them out or making some deal on something else and keeping it as clean as possible. But yeah, there are some messy term sheets, and that causes big problems, especially if a company's got aspirations of being acquired, not going public. Going public is a whole different ballgame, but if you're going to be acquired and your cap table is all messed up and like there's some people that are waiting for their equity, and it can cause real problems on the M&A process.
Okay, yeah, that's exactly what
Yeah.
How long do you think you could have kept growing the company before you would have had to start building a bigger team? And did you ever consider trying to build a team and using some of your revenue to grow that way?
Great question, and I didn't cover that here. I didn't really cover the growth of the company that well. I was more focused on the bootstrapping side of it, but we did grow the team. So I hired an engineer, somebody who had been working with me at previous companies. We hired a full-time sales rep the day that Adam joined. We had a customer success manager who managed all the renewals and all the customers. And our plan that went out for 3 years had us hiring another sales rep, another customer success manager, eventually another software engineer, and spending more on marketing. And so we were tracking about 1.3 million in revenue, and we had a plan to get to around 4 or 5 before the model broke. Before we were just like, wow, once we hit 4, all bets are off. We don't know how we're going to grow it from there, because now we've got 20 people, and to go from 4 to 8, we're going to need 80 people, and so the scale just gets bigger and bigger. We definitely had a solid plan to get us to about 4 million in revenue.
So you could have kept going for a while if you didn't sell.
Yeah, we did. That was the thing. So, my first week at Drift, I was out in Boston, and they asked me to speak at the company meeting. And I actually stood up and said, we're here today because it's Drift. This was the only company that at this time, when we had our offsite and we decided on possible suitors, this is the only company that we actually said that we would want to do this deal with. So we were in a great situation because we didn't have to do a deal. We were going fine. We were profitable. We were growing our business. Adam and I were paying ourselves, and every time we closed the deal, I got a raise. It was just like clockwork every quarter. My salary was going up to a reasonable level where now it's a livable wage, and away we go. So we could have just kept going for sure. That also puts you in a great negotiating position.
Yeah, you had a choice basically.
Yeah, exactly. Yeah.
So yeah, let's say you are contemplating on selling the company, and you got some offer. What is the process of negotiation? Can you give some insight on that?
It's brutal. Even with a company with a super clean sheet like we had. So we had the founders and a couple of employees, and that's it. There wasn't a lot of mystery to our business. Our model was good. Our revenue was good. There was no debt. Even then, a lot of the back and forth was about the equity versus cash part of the deal. Like how much were we willing to take in Drift equity versus the cash part of the deal. What would our jobs be after the acquisition? How long would we be working at Drift? What was our out and all that? Because I think that's the really typical stuff, right? As an entrepreneur, you get to this point where you sell your company, and then all you can think about is your next company, right? You got it done. Now you want to do it again. You want to take all your learnings and apply them and do it better next time around. And then if you're joining a much larger organization, especially being remote, you know, they're in Boston, they've got 250 employees now, and we've got 6 people in the Seattle office. A lot of the terms were like, well, what are we going to do with this Seattle office? What are we going to do with these people? How are we going to grow the business here? Does it make sense to have a satellite office? So a lot of the negotiating was about the terms of the deal, but also post-deal, what does this world look like for all of us?
Now that you've been within Drift for a little while, do you have an understanding of what their motivation was for acquiring you? Were they like, did you have a unique business model that they didn't understand that, you know, you understood, or customers that they wanted, or did they want your capability? Like, did they actually want you, or?
Yeah, it's interesting. I think it even shifted post-acquisition. I think pre-acquisition there was this notion that we had a lot of great technology in terms of machine learning and AI. And then post-acquisition it was more, so it's funny, Drift has a policy of you get a sabbatical after 3 years, and it's almost forced. Like you have to leave the company for a month and go do something else. And as we were negotiating the deal, David, the CEO of Drift, was on his sabbatical. So he wasn't really involved at all other than getting little updates here and there about what was going on. We were dealing with the co-founder, CTO, and their CFO on negotiating the deal. And I don't know this for a fact, but my interpretation of what happened was when David got back from his sabbatical, he actually looked at our business fundamentals and he said, Jesus, look at what these guys are doing. They've got a profitable business out in Seattle. They've got a huge pipeline of customers. They're closing deals. They continue to close deals. Let's pump the brakes on, like, you know, talking about integrating the 2 products together or leveraging the technology or moving people to other roles. Let's let them keep going with what they're doing, and let's slow roll the integration a little bit, because it just seemed like the right decision to make. And now SiftRock is still considered a separate business unit within Drift, building another business inside of Drift. So it can actually change even from what they thought they were buying it for to post-acquisition what they actually got. So, you know, it's a roll of the dice oftentimes, you know, to see what they're actually going to do with the business.
Great insights. Thank you for sharing. My question is, in one of your slides, you had mentioned your choice of going all in was influenced by the B2B model and the SaaS model. Would it be different if it is a B2C and kind of still a SaaS but B2C? Would you say all in or a side gig?
So on the consumer side, I'm not a consumer expert, but the things that I do know about the differences between B2B and B2C is that B2C tends to be a lot longer pull, right? So if you watch The Social Network and you see those early conversations that they had about Facebook, they're like years in and they're like, how do we monetize this thing? I don't know. We don't know what it is yet. We don't know how we're going to actually make money out of it. And I think on the consumer side, unless you're selling out an actual product where you're like, here's a watch I made and it's $100 and you have that exchange, if you're building like a new social network or you're building something that's a little bit more fuzzy in terms of how you're going to make your money, it's a heck of a lot harder, in my opinion, to go all in, because the all-in plan for SiftRock was, I'm building a product, I think I can charge $500 a month for it, I've validated that with a bunch of customers, so I'm going all in because I know that if I can get to 10, 12, 15 customers, I can start to actually like make enough money to live, right? And so the all-in plan to me had a lot less risk than maybe going into something where I'm like, well, I'm building this social network and I need to get to 1 million users as fast as possible, but I don't know how I'm going to do that. And like going all in on that to me just seems to carry a lot more risk. But that could just be because of my experience in the B2B space. I'm just more comfortable with it.
We have time for one more question.
Thanks, Chris, for sharing. My question is, how much of your decision for M&A was driven by the fact that Drift has $30 billion in equity funding?
A lot of it, honestly. You know, when we looked at what Drift had and you know the fundamentals of the business, we actually got to see their growth. We got to see their revenue. We got to see their customer growth, and then we got to see like the cash on hand. And for us, it was like, wow, these guys are a cut above like most startups that you talk to. When you see their numbers, and their numbers are all private, but it's quite extraordinary to see what they're actually doing. And I think in a few years, you're going to see that Drift is like a Slack or like one of these big SaaS startups that just grew so fast, it's almost unbelievable. And we saw that happening inside of Drift based on the M&A process. And that just further cemented our sort of notion that we had to try to make a deal happen with this particular company, because it wasn't just that we were doing great, it's that this particular company had such a huge opportunity for us that we really we're willing to give a little bit more, I guess, in the process of negotiating. Whereas, you know, if it were Marketo or HubSpot or somebody coming in and saying, hey, we really like what you guys have and we want to buy it, we would have been like, here's the number, we want it all in cash and like no negotiating. And if they were like, yes, we would have been like, okay. But if they said no, we would have been like, all right, see you later, we're going to keep going, right?
The reason I asked that question is because I'm currently entering a marketplace that is so huge. It's in the magnitude of tens of billions of dollars. So one of the startups getting tens of billions of dollar market size, and one of the startups is getting $40 million. So at this stage, do you still recommend me to continue? Because I think this market is big enough to contain another 10 players.
Mm-hmm.
Or do you think this is a similar situation as Drift versus SafeRock? The player is so dominant in the market and gets so much cash on hand, they can pretty much just do whatever they wanted or crash any other players. So what's your recommendation here?
I would say you need to gauge how novel or unique the product offering that you're thinking about is, because I think disrupting, we've seen it happen over and over and over again. It's funny, I just tweeted the other day, there was a report that came out that showed the 20 biggest internet companies from 20 years ago, and of those 20, only 3 of them are still real companies. 17 of them no longer exist, and these were gigantic, multi-billion-dollar companies. They all got disrupted. If you look down the list, it's like, oh yeah, those guys got crushed. You have like, MySpace getting supplanted by Facebook. MySpace was so dominant. How did they get beat, right? So I think if you're in a huge market and you have something novel or something interesting or something innovative to add, there's always room. There's always room to disrupt. Those big companies have a hard time. It's like that big ship analogy where you want to steer the Titanic a different direction. If you're in a little boat, a little speedboat, you're able to just do this and adjust to market conditions. If you're in that giant Titanic, it's going to take you a long time to turn that ship. I mean, we saw that. We had, Marketo was one of our biggest partners. About 80% of our revenue was through that channel. So our customers that used Marketo would buy SwiftRock. Marketo could have put 10 engineers to build SwiftRock in 6 months if they wanted to. They never did. Why? Why didn't they do that? Well, it was just different than what they were used to. It was a different model. We were doing machine learning. They didn't really have machine learning people. They had a roadmap already. They were already consumed by the direction that they were going, and they never even stopped to consider building what we had, even though it had clear value for their customers. So I think there's always room.
Thank you to Chris Hundley.
Thank you, guys.